Good afternoon everyone, and welcome to the first of our series of 4 webinars on incorporating your legal practice. We've had about 100 people register for this webinar, and for those of you that I already know, hi and good to be in contact again. For those of you who I haven't met before, welcome, and I hope you enjoyed today's session. Today my goal is to provide an overview of the opportunities that incorporation presents to legal firms. Firstly, just a very brief introduction about myself. I'm a chartered accountant. I'm based in Brisbane. I specialise in guiding professionals and professional service firms, and in particular lawyers and legal firms, to achieve their goals. Why I decided to do this series is I have a lot of friends who are lawyers, actually like lawyers. I also have had quite a number of clients who are lawyers, and in participating within that community, it became really clear to me that there's a lot of confusion out there as to what the real opportunity and what the real costs are for legal practitioners to incorporate their practices in various roles of being supporter and sponsorship roles with various organisations that support your industry. It always seemed to me that the information that was out there was very much focused on the larger firms, whereas here in Queensland most of the firms are 1 to 3 principal firms. And what the opportunity that exists for you as lawyers with your legal practices and incorporation, it's nothing that's new. It is new for you guys, but it's been around for all other businesses for a very long time. You know, they can incorporate, they can set their businesses up as a company. So what we're going to do today is basically run through an overview of what I see are the issues in relation to incorporation. We'll run through hopefully for about 45 minutes. If we finish up a little bit early, then I'll open up to some questions. So you're able to just ask me a question. If not, more than happy for you to drop me an email after the session, and we can have a bit of a talk. We're going to have a little bit of interaction during this webinar. There will be a few polls just to get a little bit of a feel for from where all of you are at. So we might just start that now with a very quick poll, just to give me an idea of who's listening in. So if you could just click on which one of those options best describes you and click submit. Just leave that going for a second. We're nearly there. Almost 100%. Thank you very much. So in the audience today, so that you can all get a bit of a feel for who's listening, we've got 50% of the participants are sole practitioners, 25% are in a 2 to 3 principal firm, 15% in a 4+ principal firm, and about 10% who are employed solicitors or practice managers. So welcome everybody, and I hope you really get something out of this today. What we do in our business is we work with people to help them achieve their goals, particularly professionals. And what you see on your screen now is a philosophy that we have in our business called financially well organised. And basically what it is, it's a philosophy or a structure that we use to help guide our clients to achieve whatever their goals are that they want to achieve. And structure is a very important part of this. So if you see up the top there, we have goals and objectives. That's the very first thing that we need to really have a look at. And when we're thinking about structure of your business, so the structure of your legal practice, you've got to consider that in the context of where you're heading and what you're wanting to achieve. Because unless you get really clear on the reason why you're doing it, the fact that you incorporate might not make sense to you. So step one in working out whether or not you're going to incorporate your practice is really get clear on those goals and objectives. Secondly, I see a major opportunity for incorporating your legal practices is that of asset protection. Simply making sure that the assets that you have got reduced exposure to third parties. I'm sure that's for those of you that are in the commercial legal world, then I'm sure that's something that you're advising your clients. Now you've got the opportunity to do it yourself. In terms of taxation planning is really about paying the least amount of tax possible, that's legally possible. And in doing this for years with all clients, companies are a very effective tool for reducing the amount of tax payable. However, we'll run through a couple of issues that you need to be aware of there a little bit later. But it's definitely something that you need to be focusing on, because the more of your after-tax income that you've got to use, the easier it is to achieve your goal. Your debt plan is very important as well from a structural perspective, and your debt plan is very simply making sure that you've got the maximum amount of tax-deductible debt and the least amount of debt that is provided to the banks as security. With structuring your debt also, banks and financial institutions these days are very keen to lend you money using your practice as security. Some banks will lend you up to 50% of the value of your fees for goodwill. Your retirement plan, so getting clear on when you want to make a choice that you no longer work, make a choice that you no longer want to work or to continue working. The more after-tax cash you've got to support your retirement strategy is going to definitely make that time come a little bit more quickly. Looking at your business very clearly about increasing your profitability and reducing risk, and to run through superannuation should be part of your plan as well. And as part of a restructuring strategy, superannuation can be a very critical component of it. So that's just to give you a little bit of an overview of some of the issues that you've got to think about from your own personal planning perspective as to why you're going to consider incorporation. Having a look at your usual structures. Now, I would expect, because we've got 50% of sole practitioners in the firm, I'm sure you'd be very aware that you're taxed at your marginal rates. And also your personal assets are at risk. It still amazes me the number of professionals that have other assets that are in their own names, and the exposure that has exposure of operating your business as a sole trader has on those assets. Similarly with partnerships of individuals. As a partnership of individual, your share of partnership profit is taxed at your marginal rates, which can be up to 46.5%. It's great if it is up to 46.5%, because that means you are generating some pretty reasonable profits, although there's nothing good about paying tax at those levels. Also, your personal assets are at risk, but you also throw into the equation there the joint and several liability aspect of a partnership. And I'm sure you're all aware that if you've got a partner that doesn't have any assets and you do, then you can be held jointly and severally liable for all the debts of the practice. 25% of our listeners today are, 40% of our listeners today are in that partnership structure. There's another structure being partnership of trust, which aren't as common, but we have a number of clients who are structured in these arrangements, and these arrangements were common prior to the Legal Practitioners Act allowing you to incorporate. But since 2009, they do provide you with some level of asset protection and income splitting and those sort of entitlements. But since December 2009, when they changed the Division 7A rules for tax purposes in relation to unpaid present entitlements, they're not as attractive, because you can't use your corporate beneficiaries as efficiently as what you used to be able to use them for. And then we've got the old service entities, and With service entities these days, there is no really great benefit in having them. The extent to which you can mark up your costs and charge those to your practice is very limited. Just have a read of the ATO ruling. If you really want to get confused, have a read of that. So often, more often than not these days, service entities have they're usually more trouble than they're worth. So I'd just like to do a quick poll now, just to get a bit more of an understanding of the structures that that you're all operating your businesses within. So if you could just do a quick vote there, just to let us know what your structures are. Getting there, 65%. Just a couple more seconds. Okay, thank you very much. So we have 43% of our listeners as a sole trader, which we must have had a few other people vote on that poll that were in the previous poll. 27% are in a partnership of individuals, 15% a partnership of trusts, and another 15% are already in incorporated practices. So for those of you who are in incorporated practices, what we're going to run through in a moment is those opportunities and the benefits of incorporating. So what I'd like you to do as we run through this is just to do a little checklist as you're going through to say, yep, okay, we've taken that into consideration, or yeah, we've considered that. But for those of you who are in your partnership or your sole trader, most of these issues will be relevant for you. So looking at your ILP, it provides you with limited liability. So go back to your old corporations law days when you're doing your study, and for those of you who are already continuing working within the realms of the corporations law, a company provides us with limited liability. It separates our personal assets effectively from our business assets, so that if something was to happen, and say for example you had a claim against you, the company would be liable for those debts, and your exposure will be limited to the paid up capital on your shares. I'm assuming here that as directors that there's nothing that would happen in that instance that would expose your assets as well. But I'm sure you will understand that the personal assets of directors can be accessed by creditors. So it provides us with limited liability. Having some liability is so much better than having none at all. And your structures of individuals, being either a sole trader or a partnership of individuals, you really have no limitation to your liability at all. So that's one benefit. The next opportunity is paying a tax rate of 30%. And I'm sure that there's a fair few of you out there who are paying tax at a higher rate of 30%, either at 37% or at 45%. What a company does, it pays tax on its profits at 30%. But what it then does, it distributes its profits at different times via dividends. And depending on the tax rates of the individuals, there may be some additional tax payable, or there may be some of that 30% tax rate that gets refunded. That's the way the dividend imputation system works. But the important part is that your first level of tax that you pay is at 30%. Whereas if you're in a partnership of individuals or a partnership, or you're a sole trader, it's whatever your direct marginal tax rate is that you pay. So at least with having a tax rate of 30% in a company and getting the correct structuring right, then what you're able to do is you're able to manage your exposure to taxation. Now, in any restructuring that you do, you're able to, and it's quite okay to pay legally the minimal amount of tax possible. But in any restructure, you've got to have other predominant purposes as to why you would restructure. So there's a bunch of other reasons why you need to restructure, just to make sure that you don't have any Part 4A tax issues. But with that to one side, the shareholders of your ILP can be a trust, and usually a discretionary trust. If you've got 3 partners, you can each own a discretionary have a discretionary trust act as your shareholder, and with that shareholder, it can own your interest in that company in proportion to your equity share. The benefits of having a shareholder as a trust, one is it actually provides another layer of protection to your other assets. It allows you to, you can use that trust for ownership of other assets. It's able to receive fully franked dividends, so that's tax dividends from the company. But what you're also able to do then with that trust is you're able to split the income and spread that income over a range of beneficiaries. There's some tax issues that you've got to consider in terms of having a trust as your shareholder, and they're things like making sure it's elected to be a family trust and making sure that the distributions are within the group of family members. But income splitting is it's a very important part of paying the least amount of tax. Take for example a husband and wife where the wife works part-time, the husband being the lawyer, and the wife is making wages of $50,000. But you've also got an 18-year-old child that's off to university. Basically what you're able to do is to spread that income over those lower tax rates, so that your child, who no doubt you'll be supporting at university, is able to receive that income and be taxed at their marginal rates. The wife is able then to receive a income distribution and take her up to either $80,000 of income or to $180,000 worth of income from those dividends, just so that you get access to those lower marginal rates of tax. And you can do that at different amounts in different years, and that's just the mechanism of utilising a discretionary trust. One major opportunity is that if you have debt within your practice and you are currently earning over $80,000 worth of profit, then to reduce that debt in your practice, you need to do that to pay the principal off after the payment of tax. So if you're paying tax at 45% plus Medicare levy, so 46.5%, if you earned $100,000, you're only going to have left $43,500 of that money, so it's over and above the 180, so $53,500, sorry, to pay off that loan. Where it's on the same $100,000 worth of income that's earned within a company, the company will only pay tax at 30%, so you've got $70,000 to reduce your debt by on the same amount of income. So the long-term compounding effect on your debt reduction is extremely significant, because you basically, if you're at the highest marginal tax rates, you're getting another 16.5% of the same income to clear debt. So that's a very important strategy that a lot of people don't take into consideration. And when you look at should I incorporate or shouldn't I incorporate, and you look at your long-term wealth creation, your long-term strategic planning, you've got to take into account all of these benefits, as well as what the costs of doing it are, which I'll cover off shortly. When we run the next webinar in a month's time, I'm going to, it's on the personal impact for principals in firms. I'm going to delve into these issues in a lot more detail for you. So please make sure you register and come along to that one as well. Also in relation to the small business CGT concessions, these are quite complex concessions, but fundamentally, if you are a business that has got turnover of less than $2 million, or as a partner in a partnership, your net assets are less than $6 million, excluding your home and superannuation, then you can get access to these small business CGT concessions. And in restructuring your business, they provide a great array of different opportunities for how you can restructure your ownership interest and improve your net position to help you achieve your goals. I'll run through a couple of those in more detail in a moment, but we'll go through that in a lot more detail when we're in our next webinar. The ability to utilise concessional superannuation contributions, you can do that in your current structure. So that by incorporating it doesn't produce any greater opportunity for you utilising concessional super contributions, but how you fund and access those contributions can be really relevant. So take, for example, that you are paying tax at the highest marginal rates and you incorporate, and you've then got that 16.5% of extra after-tax income to do something with. What you're able to do is then maybe even use that money to further reduce your tax and put that into superannuation. So by getting the structure right, it can free up cash flow that you've got other options and other things that you can do. Simple succession planning. Now this is probably one of the main reasons why I've created this this seminar series. And for me, simple succession planning seemed to be the major message in all the information that I had come across and the presentations that I've been to, that the incorporation makes succession planning simple, and it does. So I've seen businesses, law firms that have had, and some of you who are in partnerships may have this already. Some of you who are sole traders, you may have been in these arrangements. Situations where there's been mergers over time, where they're running effectively 3, 4 or 5 different firms with the service trust, and to introduce a new partner into that structure is an absolute nightmare. Hopefully hopefully there's a few practice managers there that are sort of saying, oh, thank God we can simplify into an ILP, because no longer I have to keep 5 or 6 different sets of financial statements and work out every year and every month sometimes who bills what and how it all works. So succession planning becomes very simple because your company can either issue shares or transfer shares to incoming partners. Also, the conversion of non-deductible debt. So how your practices are structured right now is that if you're an individual of a partnership of individuals or a sole trader, you'll have an amount of WIP and debtors that you've got access to funding to, and quite often I see in practices that they just have these amounts of WIP and debtors that are sitting on their balance sheets, but they still have this non-deductible debt sitting outside of their firms. And there's an opportunity straight away there to restructure your debt so that that debt is actually funding your business assets. So that's to fund WIP and debtors and your plant and equipment and so on. But in restructuring your goodwill in your business, often there is also an opportunity to convert some of that non-deductible debt into tax-deductible debt. And I'll show you how that can work in a moment. So that's just a bunch of different opportunities that exist that you need to take into consideration when you're incorporating. So how does it work? The mechanics are pretty simple, and this is just the usual way that that incorporation, not just of a law practice, legal practice, but of any professional practice happens. And often if you think about it, if you were advising a client of yours who is looking at a business sale, unless they're selling the shares in their company, usually it will only be the goodwill and the fixed assets that are sold. Often other cash flow style assets and liabilities stay with the vendor. So you've got your old practice, it'll have a value of goodwill to it, generally. Some businesses don't, some businesses do. So it's making sure that you've got the value of that goodwill assessed, because when you're transferring assets not at arm's length, for stamp duty and for capital gains tax purposes, they need to be at market rates. So you get your practice value for goodwill. You've also got all your old practice fixed assets and your staff, leases, the employee entitlements that go with that, and so on. And your ILP transacts with the existing partnership to simply buy those assets. The question then is, how does it fund it? So it can fund it a number of ways. It could fund it via an equity issue. We'll cover off that in a moment very quickly. It could fund that simply via vendor finance. So it could just owe that money back to the previous owners, or it could fund that purchase via debt from the bank. So that's as difficult as it gets. It's really looking at what your current practice is valued at, looking at the goodwill, fixed assets, and then transferring over all of your entitlements and other business type arrangements like leases and so on. If you've got a service trust, you also collapse that service trust and transfer its assets across into the ILP, because by having your shareholders as trusts, it achieves exactly what your outcomes would have been if you're operating a service entity, except 100% of your share of profits can exist within that trust. What happens to your old practice? Well, it's got its old practice WIP and disbursements. It's got its old practice debtors. These just stay in the old practice, and it's a matter of just having arrangements between the new practice, the ILP, and the old practice as to how those WIP and disbursements get billed. I've seen at different times the ILP act as agent and just bill single bills for all the matters, and then reimburse or transfer the old practice's share back to them. Sometimes you see double invoices being done, many different ways of doing it. From your old practice debtors perspective, those debtors just get collected by the old practice. But this also raises then the issue of how you're funding your ILP. So sometimes what happens with the collection of these debtors and the conversion of this WIP is that once those assets are collected, then they are lent to the ILP to fund its operations. Sometimes it's just the growth in WIP and debtors in the ILP that that they go and get funding from the bank. So there's a number of different ways of doing that, but effectively those assets stay in the old practice. So the costs. There are some costs, and these costs are the main two costs that that people consider. Firstly, stamp duty on the goodwill and equipment. Yes, there's stamp duty. It's a big focus of people to say, oh, is that stamp duty cost me so much, it's quite inhibitive in terms of allowing me to do this transaction. But what you've got to focus on is you've got to get a balanced view. You've got to take a look at what all those other implications are. You know, what's the impact of structuring debt into a 70% tax environment? What's the impact of having a shareholder being a trust? What's the impact of conversion of non-deductible debt? What's the impact of being able to restructure the equity that I've got in my business effectively into superannuation? It doesn't own, the equity isn't owned by a superannuation fund, but there's the opportunity to actually increase the value of what you've got in superannuation. Very important these days, given the changes to the superannuation laws in 2007, which restrict the amount of contributions that we can put into super by applying small business CGT concessions, and also if you've got a pre-CGT capital gain, there's even a greater opportunity of getting amounts into superannuation. And also, thank you, the Labor government, for splitting our contribution caps in half. Time will tell what will happen there. But you've got to take all of these things into consideration and weigh them up against the costs. Payroll tax is another one, and I've just set up to payroll tax maybe. You've got to have over $1 million of wages in Queensland to be paying payroll tax. But at the end of the day, if you understand how payroll tax works, you only start paying it over $1 million, and then it reduces. You end up paying payroll tax. That threshold reduces by $1 for every $4 over and above that 1 million, and then your tax is levied. I think it's at 5%. So the real amount of payroll tax that you pay is actually quite insignificant when you combine that with all of the other opportunities that an ILP presents you with. So if you look at those two, combine them in total to work out what the impact of that is, and there might be a few other costs, but quite minimal. Your accounting costs shouldn't change because you're still just doing one practice. Whereas if you're one of those practices that have got 5 different entities, you actually get a saving there. So if you combine those with all the benefits, then you get a significant, you'll see that there's a significant upside in most cases. But you need to consider, and every situation is different though. So looking at your taxation benefits, now remembering that restructuring into an ILP, it should not be for a predominant purpose of obtaining a tax benefit, but it's important to still understand what those benefits are. So first of all, we've touched on this, is that you've got a tax rate in the company of 30% versus your marginal rates for principals. When I take over law firms' accounting work for new clients, and they've got service entities, I'm still seeing to this very day significant markups on the costs of running a business, even when there's only 1, 2, or 3 principals or solicitors in that firm, and their costs not being that significant, but significant markups, and they're accessing income splitting on the basis of those markups to reduce their marginal rates of tax. So that's something that's fraught with danger a little bit these days, given the tax office's views on service entities. But fundamentally, the majority of the profits in most practices where you've got sole traders and partnerships of individuals is resting on those principals and their marginal rates of tax, and often greater than $180,000, so paying tax at the highest marginal rate of 46.5. That's just giving money away when you don't have to. Income splitting, so that we've touched on that. That's a significant benefit from a tax perspective. It just improves your cash flow. On every $100,000 that you make over and above 180,000, if you've got tax being levied at 31.5% to a beneficiary of a trust, then there's a 15% tax saving. If that tax benefit is, if that tax amount is 16.5%, then you've got a 30% benefit. So you've really got to take that into consideration. We touched on conversion of non-deductible debt, so really how you structure your affairs of your ILP going forward. You can still have the same amount of debt, you might still have the same exposure, but sometimes there is an opportunity, looking at how the business needs to be funded, to reduce your home loan debt and put that into your business. I just want to run a very quick poll again. I just want to see who out there has got some non-deductible debt. So moving along, another couple of seconds. Tell you there's a lot of you. We're about, what's that, 61%. 60% thereabouts of our listeners have got non-deductible debt. And it wouldn't surprise me if there isn't opportunities within your business structure and how you even are funding your assets at the moment to be able to restructure some of your personal debt and restructure it into your business, even if it's not an ILP, and get some conversion to non-deductible debt. And probably the last main benefit there, a significant benefit from a tax perspective, is around superannuation. I mentioned before that there's an ability to restructure your equity effectively into superannuation. I'll cover that off in a moment when we look at briefly the small business capital gains tax exemptions. But I'm really looking at here the benefit of getting your as much of your equity base as you possibly can into superannuation. For those of you who are under 40 or in your early to mid 40s, you see as superannuation being a long way away. I have clients that are 30 years old right through to 85 years old, and 87 years old. And what I see with them is the benefits of the differences in the lifestyle of those people who have started superannuation early. What an ILP allows you to do, it allows you to free up some of your cash by paying corporate tax rates to get more money into super. And what I see is the benefits from age 55 or age 60 for those people who actively focus on superannuation strategies and having their income now or their assets now in either a 15% or a 0% tax environment, both on the way in and both on the way out of super. I say 0% because once your fund turns on a pension and when you are over 50, then there's over 60, there's no tax within the fund and it's not taxable when it comes out to you. Between age 55 and 60 is a different story. For those that are born after 30 June 2004, got to wait till 60 to be able to access your super anyway. But by having the right structure here, it allows you to think longer term. And that's, if we go right back, just to flick back here to our financially well organised strategy, what we're talking about is we're focusing here on what our goals and objectives are and what are the reasons why we are going to structure our affairs into an ILP. And if you can get the benefits of superannuation, I can guarantee to you that in your retirement you will be in a much stronger position than where you otherwise would be. Some other taxation issues to consider. Firstly, small business CGT concessions versus rollover. Two options to make sure you pay a very low amount of capital gains tax or none at all. You can do it either via application of the small business CGT concessions, that is if your turnover is less than $2 million, or if your net assets are, excluding your home and super, are less than $6 million, you're able to access, generally if you're in a sole trader, partnership of individuals or a partnership of trust, you're able to access a 50% discount on your capital, of any capital gain that you make on the sale of your goodwill, provided you've had the business for more than 12 months. You can then get access to another 50% CGT discount or reduction called an active asset reduction. Lastly, that you're able to either consider a small business CGT rollover or put up to $500,000, and depending on your structure, it may be up to $1 million into superannuation as a retirement benefit. That's tax-free on the way in and tax-free on the way out of superannuation. The right structuring and funding strategies in place, all of those things are possible. So it's a matter of considering all those issues. Another thing, another little bit of a trap that people fail to consider when they incorporate is moving from a cash to an accruals basis of accounting for tax purposes. So when you're in a cash basis, you're basically paying tax on your receipt of your bills that you've rendered. When you move to a company, you will move to an accruals basis. So basically you pay your tax when you raise your invoice. So it's an important bit to consider when you're incorporating the impact that that has on your cash flows, and particularly in relation to what you put aside to save for tax in that first year. Another issue, and if anyone follows me on my Grow Your Beans blog, I wrote about this issue last Friday. Often another issue that's an oversight by a lot of advisors, but also by a lot of practitioners, legal practitioners out there. There's an old tax ruling that says if you don't have at least equal to or more of the same number of non-principal fee earners in your business than principal fee earners in your business, then those profits you make will be personal exertion profits, which means that they cannot be retained in your company. Versus if they were business profits, so you either had the same as full-time equivalent or more full-time equivalent fee earners, say solicitors, then you're able to retain those in your company. So it's another thing that you've got to be very mindful of taking into consideration in addressing all of these issues before you incorporate. And also there's some significant cash flow upside in the early years for when you move out of your PAYG, current PAYG instalment regime to the corporate PAYG instalment regime. New taxpayers only start paying PAYG instalments after they have lodged their first tax return. So if you set up an ILP on the 1st of July this year, your first tax return won't be due to be lodged until around May of 2014. So up until that point in time, the tax office won't issue you with any PAYG instalments. So basically what you do, you get the benefit of the retention of that cash for almost up to 2 years. You've got to put it aside, you've got to keep it because it's going to be payable. But in those first almost 2 years, you're able to hold on to your cash and either reduce the amount of interest that you're paying on your debts or earn some extra interest on it whilst it's accumulating. So it's a bit of a cash flow relief. What it also allows you to do, because you're going to be receiving dividends, or you may also be receiving wages from your ILP, what you're able to do as a partner is, because your dividends are fully franked, meaning that they're already going to have tax paid on them by the company, what you will be able to do is you'll be able to reduce your PAYG instalments in your own name, and that will also reduce some of the burden of your own cash flow in funding those instalments, which might be some of it at 46.5% on a quarterly basis. So they're just some of the other taxation issues to consider. That's what I think are the main issues that you've got to consider when you're looking at restructuring your business into an ILP. Now it's a new thing for you as lawyers. Well, it's not that new. It's 5 years old almost. But for the rest of businesses of the business world, or most of the rest of the business community in Australia, it's a very normal thing. So restructuring is something that you've got to take into consideration in helping you achieve your goals and objectives. So I'm going to wrap it up there in a moment, but before I do, what I'd like to do is I'd like to offer to any of the participants today, so firstly just to say thank you, but for the first 15 to email me a free 45-minute one-on-one telephone meeting to discuss your practice and how these things might apply to you. Now I've gone and blocked out 3 full days to conduct these meetings, just running 5 a day on Tuesday the 3rd of April, Wednesday the 4th of April, and Thursday the 5th of April. So all you need to do is email me at matt@elliotsgroup.com.au, And just say you'd like to take up the offer, and Margie Finlay, my executive assistant, will be in touch with you, and we'll schedule in some times to have that discussion. Also, the next three webinars that we'll be running, they'll be 12 noon again for 45 minutes, Australian Eastern Standard Time. We'll go into a little bit more depth, into some more depth over these issues. So the next one will be about the upside for principals. So we'll get you some more clarity around those opportunities for you as the principles of the business in relation to your personal, the personal impact it can have for you. So that's on the 19th of April. Another one on the upside for the practice, so looking at what the issues are for the practice and how it needs to, what it needs to consider in terms of funding the strategy, the impact as an employer, the impact as from a funding, from a cash flow perspective, and then in our third ILP. Our third webinar out for ILP will be on the real long-term return on the 21st of June. So that's where we'll delve into, how this planning can have a real impact for the business overall. For those of you who may have seen it, I had a couple of articles over the last few months in Proctor. First one on getting the most out of incorporating your legal practice, and second one more recently this month on putting it into context, incorporation. So have a look at those articles. I'll give you a little bit more background. If there's more information that you're wanting to gain, I'll run through in a moment some ways of you accessing that. But after this webinar finishes, you'll get an email. I'm just asking for a little bit of feedback. So please provide me with feedback, both good and not so good, just so that we can improve this for you. After the finalisation of the fourth series, webinar in the series, I'm also going to be asking for any ideas on other topics that people would like me to cover off, and we'll keep this monthly webinar series going. If you want to follow, if you want to follow some more information, you can hop online and go to elliotsgroup.com.au and subscribe to the weekly Grow Your Beans blog that I do specifically for law firms. Also send me a connection through LinkedIn. Those blogs get posted on there every week, but send me a connection. I'd love to connect. Also, you can follow me on Twitter at Fishrots, and there's a whole pile of other resources that might help you in your business at our resources website, financiallywellorganised.com. So I've run a little bit over time, but thank you for your attendance. I hope that's been of value to you. Please give me a call or drop me an email if you've got any questions. But just remember, email me today. First 15, we'll have a discussion one-on-one with you privately and your partners about your practices. So thank you and good afternoon.